It was probably the biggest crypto meltdown of all time. Yes, today we're deep diving into the collapse of blockchain Terra, charting how its native cryptocurrency Luna went from being a top 10 token that only just hit all-time highs to becoming completely worthless in just a matter of days. But how exactly did it happen? I'm Teddy, and that's what I'll be taking you through today. Stay with me as we dive through a timeline of key events leading up to Luna's ultimate descent from a $40 billion market cap crypto to practically nothing. Let's begin. In many ways, you can't get to Terra without Lehman Brothers. 2008, the financial crash. $9 trillion worth of wealth is wiped out in just 18 months. 2.6 million people lose their jobs in the US. It's a global nightmare that highlights all the worst excesses and vulnerabilities of the capitalist system in which the West is built. People were livid, taking to the streets and to online forums and newspapers worldwide to demand change. And on a particular forum, in an obscure and quiet corner of the internet, some unknown entity finally decides to take matters into their own hands. They write, "I've been working on a new electronic cash system that's fully peer-to-peer with no trusted third party." The Bitcoin whitepaper released by Satoshi Nakamoto in late 2008 resembled a challenge to the establishment, providing a blueprint for a new kind of value storage free from the interference of governments and Wall Street. Obviously, everyone knows what Bitcoin is now, but back then, after its launch in January 2009, it was considered a niche club of folk like Hal Finney and Gavin Anderson. You know, these guys were mathematicians, developers, libertarians, and tech heads that wanted to change the world, discussing their new ideas on sites like Peer-to-Peer Foundation and Bitcoin Talk. They're about as far away from New York investment bankers and hedge fund managers as you could get. And this free-flowing spirit of experimentation showed across the early days of the Bitcoin project itself. The fledgling coin, which initially had a price of just a fraction of a cent, was prone to losing 80% of its value on a whim. I mean, people used it to buy drugs on Silk Road, the Mt. Gox exchange just collapsed out of nowhere while CEO Mark Capellas was like baking quiches in his Bitcoin cafe. A hacker minted 184 billion BTC due to a bug in the code. 10,000 Bitcoin was spent buying a pizza. I think you get the idea. It was clear even from the very early days that crypto was a fresh and exciting premise and had promise, a lot of it. But for the ecosystem to grow and mature, eventually people would want to come and have a store of value that was, well, a little bit more stable. Enter stablecoins.
No. Be connected.
A cryptocurrency that can be tied to almost any other asset, keeping a consistent, supposedly unwavering value at all times. It meant that no matter what, your one stablecoin would be worth $1, and you weren't going to wake up to find yourself bag holding 80% less wealth than you did before you went to bed. Theoretically, anyway. The first stablecoin hit the market on July 21st, 2014, when BitShares released BitUSD. Since then, 4 main types of stablecoin projects have emerged. Firstly, fiat-backed, which are stablecoins supported by one or more fiat currency. Tether is a good example here. For every one USDT out in the digital ecosystem, it supposedly keeps one real-world American dollar in its reserve funds. And then secondly, we have crypto-backed. Now this acts the same way as fiat-backed coins, but the reserve is cryptocurrency. For example, DAI's stablecoin is backed with Ethereum. And thirdly, which is pretty not very popular or common, is commodity-backed stablecoins, which are supported with commodities like gold or oil or, I don't know, pig bellies maybe. And finally, most important to this video, are algorithmic stablecoins, which instead of having a reserve asset to back it, rely on an algorithm to maintain a consistent price. Okay, now with that done, enter Terra. In 2018, a DeFi project going by the name of Terraform Labs is formed by 2 South Korean nationals, Do Kwon and Daniel Shin. With their small team comes a vision to shake up the emerging crypto sector of DeFi. And while there isn't a lot of total value locked in the space at this time, it was growing in potential. Hundreds of projects were being launched, pushing the limits of what blockchain could do. You had lending ecosystems, insurance blockchains, crypto kitties. But Terra? Well, Terra just wanted to bring stability and encourage adoption to all of this, as per their white paper. So aptly, they begin their R&D of stablecoins, but more specifically, algorithmic stablecoins. Algo, what you say? What is this thing? Okay, to explain what an algorithmic stablecoin is, we're going to use some Lego I got from home. Yes, I know. Just bear with me. Now, these red Legos represent stablecoins you want to stay pegged to $1, while these blue Legos denote an entirely separate token that's used on the same blockchain but doesn't have to be pegged to $1. Now, whenever the demand for the stablecoin gets too low, there's a threat people won't want to pay $1 for it. Fair enough. So to stop this, the algorithm will reduce the supply of red Lego. According to the laws of supply and demand, in a liquid market, an asset will always reach an equilibrium where its demand equals the supply available. So if you reduce the supply of the red Lego, but the demand of it remains the same, the price has to re-establish the balance. This is how it gets back to a $1 valuation. And the same happens in reverse. If demand is too high and people are willing to buy this red Lego at say $1.05 just to get it, then increasing the supply will create an imbalance where there are more red Lego than people who actually want it. And so to re-establish the balance, the price naturally has to drop. But you can't just take red Lego out of people's playsets, nor dictate that they should have more in them. You have to create an ecosystem where people naturally want or not want the Lego in their own terms, but still in line, obviously, with your wishes. Algorithmic stablecoins do this by incentivizing users to burn or create red Lego by offering them money to do so. So, in our simplistic example, when demand is too low, holders are encouraged to throw away $1 of red Lego in exchange for $2 of blue Lego, our other cryptocurrency, remember, that doesn't have to be pegged to $1. And so supply drops and the price of red Lego rises. Likewise, when demand is too high, the algorithm incentivizes people to burn 50 cents of blue Lego and create a new red Lego block, increasing supply and therefore lowering prices. This is a form of arbitrage, and it's what Terra wanted to use to ensure its stablecoin always stayed at $1 without having to have one real world dollar in a bank account somewhere to back it up. However, it would be a few years before their UST stablecoin and its supporting cryptocurrency Luna were ready for public consumption. But while they worked on their project, the whole crypto landscape started to change dramatically. February 3rd, 2020. The US officially declares a public health emergency, taking the whole COVID thing up a notch. Borders and businesses shut, people are ordered to stay in their homes. The global economy is a deer in the headlights and the stock market has its worst day since 1987. Look across charts and you'll see this flash crash. So, as the world saw the most drastic event in years, ever for us young'uns, suddenly people had a lot of time to kill, a fat Stevie check on the way and an apparent market dip right there to take advantage of. So, what happens next? Madness, of course. Companies like Zoom, Etsy and Tesla start seeing triple-figure gains. People start aping into GameStop and AMC trying to short squeeze hedge funds, and add Bitcoin's 4-year halving into the mix, and all of this pent-up mania spills over into crypto. The ensuing bull run in late 2020 sees Bitcoin pump to an all-time high of over $64,000 only a year after its halving, giving it a market cap far greater than Warren Buffett's Berkshire Hathaway. Coinbase IPO'd thanks to its user base rising 300% to reach 8 million, while Bitcoin addresses went from just 3.5 million in January 2020 to almost 7 million by the height of the bull market in May 2021. I mean, this was a year in which people bought a picture of a rock on Ethereum for $2.8 million, and Elon Musk sent the price of Dogecoin rocketing, claiming it was the people's crypto. Everything kind of went loopy quite quickly. But in the process, crypto goes from a niche fringe project to a household investment decision. Even my mum bought in. Risk is forgotten about because 100k Bitcoin is now a guarantee. Due diligence is just a yada yada boomer concept. And most importantly of all, if you're a DeFi project wanting to stand out from the crowd, you better be offering something the others aren't, or you can jog on. Having spent the previous 3 years sharpening its knives, Terra finally launches its algorithmic stablecoin UST with their Luna token being the collateral backing it up. The blockchain's algorithm will basically just be the arbiter of the two, burning and minting them alike as the supply and demand levels change. Think of it how we describe the Lego, but also how Terra markets itself. UST will be the Earth and Luna will be the Moon, relying on each other for sustainability and stability. They have a problem though. They spent so long creating their ecosystem, they're kind of late to the party. By the time UST launches, Luna has a very modest market cap, let's be honest, for crypto, of $190 million, with UST sitting even lower than that. Meanwhile, leading stablecoin Tether has a market cap of $15 billion and rising quickly as people rush into the space under the sway of the bull market. So, how could Terra get people on board with UST at this crucial moment in crypto? Simple. Show them the money.
Show me the money.
Terra's first true success with UST came from Mirror Protocol, a place where basically traders could place highly leveraged trades on mirrored versions of US stocks. Crucially, UST was the only stablecoin you could use to make these trades. And in doing so, any YOLO-minded traders wanting to use the platform had to use this new stablecoin. And of course, it worked. By May 2021, Mirror grew to be the 15th largest DeFi protocol by total value locked, with $118 billion of collateral locked in the protocol. UST hit a market cap of $2 billion to make it the 6th largest stablecoin, and despite complaints from the SEC about Mirror Protocol, they actually subpoenaed Do Kwon on an elevator of all sorts. Kind of weird. It seemed offering lucrative and risky ways of earning profit was exactly what investors wanted, but perhaps a bit too much. A DeFi lending platform called Anchor launches on Terra, and it wants to lend your UST so bad it's willing to offer you a whopping 19.5% APY rate on all the UST you deposit with them. Now, if you flunked math like I did, that number might not mean that much to you, so let's break it down. If you deposited $1,000 with Anchor at 19.5% APY, by the end of the year you'd have $195 extra earned in your account. With a traditional savings account, however, with any American bank most likely, you'd be only doing well to get like 0.07% APY on your savings, which is like an extra 70 cents. Nothing. This almost seemed too good to be true. I mean, people were literally saying this at the time. And you know what? They might have been onto something. Here's James. It's May 19th. He just logged on to his TradingView account to check out his $10,000 worth of savings he put on Bitcoin because his mate at the pub told him to.
Oh dear.
Unfortunately for James, this day saw $8 billion worth of liquidations triggered thanks to Bitcoin losing as much as 30% in 24 hours. Luckily for James, who just paper trading, he's actually $17 million up today because he's short in the market. GG. But yes, the shockwave rippled through the crypto market, eventually leading to UST to lose its peg for the first time ever on May 23rd, falling to 94 cents thanks to the incoming supply of people panic selling UST, outstripping the number of people burning UST and minting Luna tokens for a profit. Thankfully for investors, the stablecoin eventually fully regained its peg on the 29th of May, but the first proper example of the algorithm's ability to buckle under pressure had been displayed. Terra had made a lot of money in the space of a year. Luna was now a big-time cryptocurrency with a market cap north of $30 billion, challenging the likes of Solana and Cardano. But with this rise to stardom came an even more pressing need to ensure the stablecoin never lost its peg again like it did during the May 2021 crypto crash. So, Terra launches the Luna Foundation Guard, a fund designed to eventually buy up around $10 billion worth of Bitcoin and hold it, acting as an independent reserve for UST. It's basically a backup in case the algorithm fails to keep its peg, which may work in normal conditions, but what happens when people start playing with the system in ways they weren't entirely supposed to? Abracadabra. There was once yet another DeFi protocol, and it's called Abracadabra, and it allowed users to deposit UST as collateral to mint its own currency, Magic Internet Money, or MIM. But get this, so-called DeFi degenerates then come up with a scheme and call it the degen box, which was a strategy to basically get lots and lots of yield from a rinse and repeat process of depositing UST on Anchor, then taking the AUST reward from Anchor to mint MIM, which is then used to buy more UST. and on we go. It's a kind of convoluted process to get into here, but all you need to know is that this exploit leaves UST very vulnerable to depegging if suddenly these people need to unwind from their highly yielded positions. And what do you know? The news gets out that one of the guys working on Abracadabra is a co-founder of this thing called Quadriga CX, which was a crypto exchange that collapsed under suspicious circumstances in 2019. And people get spooked, dump way too much AUST back onto Anchor all at once, and given the over-collateralized nature of the token, UST temporarily falls slightly below its $1 peg. Terra is booming. But at the end of March 2022, investors get a relatively unnoticed signal to take their money off the platform. Only a few weeks after Abracadabra's collapse, Anchor changes its rate structure, dropping interest earned on UST by as much as 1.5% per month as a way of increasing its yield reserves, which basically means it wants to increase the amount of capital it has at the ready to pay out the high interest it initially had offered those depositors. At this point, serious questions are already starting to get asked at a higher and higher frequency, like this guy and this guy. But for the most part, this quiet red flag that Anchor's high yield rates seem no longer viable hardly made any headlines, and people kept their money in. In fairness, the crypto market was doing crazy things at this time, and the Federal Reserve was pivoting into a hawkish stance. I guess people were just too busy tolling their Armageddon bells for anyone to notice. Which was probably another signal to get out, but hey ho. We're at the high watermark. The total value locked in the Anchor system has risen in a year from 1.1 billion to 17 billion. In the midst of all these euphoric gains, the circulating supply of Luna hits an all-time low as tokens are burned to keep up with the rising demand for UST. Remember, when demand rises, the algorithm incentivizes burning Luna, so to create more UST, increasing the supply and thus lowering price. And get this, by this point, 70%, yes 70% of all UST tokens are currently deposited at Anchor, earning those juicy high interest rates. Anchor basically is UST at this point. Thanks to this, Terra is now the biggest DeFi crypto in the game, with a price of $119 up 30,000% since it was first introduced into the sector. However, behind all of this, the borrowing demand for UST is now a hair follicle away from decoupling from the actual money Terra has to unfold the interest being offered on the borrowing itself. This now fragile state means all it really takes is one whale to take advantage of the fragility. So, can you guess what happens next? At 3 minutes to 10 on a Saturday night, an unknown whale, which has since come to be dubbed as Wallet A, dumps $85 million of UST, swapping it for another stablecoin, USDC, on Curve Finance. Now what follows next gets very technical, but as we understand it, and if we have got it wrong, do let us know in the comments, a number of highly knowledgeable, pretty well-funded participants noticed that the swap has pushed the pool out of balance. There's way more UST in it in proportion to other stablecoins. These wallets have withdrawn massive amounts from UST from Anchor, proceeding to make their own swaps of UST to other stablecoins, adding to the imbalance and reducing the pool's liquidity, which, as a recap, is the ease in which an asset can be converted readily into cash without affecting its market price. This pressure causes UST to depeg. The exploiting wallets then use the resulting price discrepancies as an arbitrage opportunity between other exchanges, adding further to withdrawal of UST from Anchor and its dumping across multiple platforms. Now, both Jump Capital and Nansen AI have done very informative post-mortems into exactly how this whole process unfolded. We've included a link to their work in the description below. But basically, their actions create a cascade that pushes an already teetering system completely over the edge. People are spooked. By now, the whales of all the smart data are jumping ship. Platforms as big as Celsius begin unwinding on their positions. Do Kwon himself, however, doesn't seem overly concerned. The morning of the 8th, he tweets, "I'm up. Amusing morning. Anon, you could listen to CT influencers about UST depegging for the 69th time, or you could remember they are now all poor and go for a run instead. What are you doing?" And for a moment, things did seem okay. But while UST manages to recover its dollar peg, capital is still running for the exit. By the morning of May 8th, 3 billion has already fled Anchor Protocol, the hub of UST. This is no hiccup. To put this into perspective, before the Saturday night withdrawal, Terra boasted $14 billion worth of liquidity on Anchor. So we're talking more than 20% has drained in 24 hours. UST loses its peg again, this time falling as low as 75 cents. Luna tanks 52% to $29 on the same day. A further $2 billion gets drained from Anchor as people panic swap UST for other stablecoins. Recognizing this was basically DEFCON 5, Do Kwon tweets, deploying more capital. Steady lads. And so the Luna Foundation Guard agrees to deploy $750 million worth of Bitcoin to buy up this excess of UST on the market, desperately trying to shore up for the vanishing demand for the stablecoin. By Tuesday, Luna, once valued at $119 a token, is down to $17, dropping a further 42%, while UST is clinging on for its life around 80 cents. Incentivized by the now low price, lunatics as it were at this point, let's be honest, start minting Luna by burning discounted UST, immediately selling it off on the exchanges for profit, flooding the market with more and more tokens. In a final act of martyrdom, Terra decides to sacrifice its native token in a bid to try to get UST back to $1. It agrees to increase burning and minting capacity from 293 million to 1.2 billion. This means the algorithm is now in overdrive. In exchange for burning a load of UST, trillions of Luna would now have to be minted. Trillions. The massive increase in supply renders the Moon-inspired token a virtually worthless asset. The minting frenzy had been a last-ditch effort by Terra. It not only cratered people's investments in Luna, but it also left their very own blockchain vulnerable to attacks. And so, on May 13th, Terra halted its blockchain. It's all over. There we have it. 13 years, 7 months, 29 days after Lehman Brothers filed for bankruptcy, Terra was finished. But of course, the story's not over. There's lots of twists and turns still coming out, every day, even now. Luna's been renamed to Luna Classic and Luna 2.0 is here, and questions about how Terra's $3 billion worth of Bitcoin was used are still swirling around. You name it, the rumor mill is running it. But that could be a completely different video entirely. The important question is, what can we learn from all of this? Well, the way I see it, there are two major forces in play throughout this entire event. One is the increasing complexity of crypto projects, and the other is the decreasing knowledge of your average market participant as more and more people come into the space. Financial participation in of itself is a good thing, of course, but when projects like Anchor are offering such tantalizing sky-high returns, yet the mechanics of how they're able to do so are obscured in layer after layer of technical complexity, a true understanding of risk can't really be attained, nor understood by the average retail investor attracted to the project. And add this to Terra's systematic vulnerability of relying on their algorithm to guarantee a pegged price, and you have very little room to maneuver if things ever go wrong, which they did. For me personally, the core learning is about what individual crypto enthusiasts can do to better equip themselves when projects like Terra come along in the future, because of course they will. How perhaps we should be a little bit more cynical in the face of too good to be true claims and give the naysayers more room in our thoughts, spending time on our research before YOLOing into stuff. Sure, this is only one part of a much larger set of actions needed to bring about a solution, but it is a part we can actively change ourselves. And that seems like a positive thing to bring out of all of this. What do you think? Let's talk over in the comments below, and do let us know if you like these deep dives. All feedback, comments and support and criticism helps us make even better videos in the future. Until next time, look first, then leap.